Let's now make a start on today's workshop learning objectives. Now, every single workshop we have a series of learning objectives that we work through, and there are a series of videos related to each individual workshop learning objective. Okay, so what we're going to look at now is what we're looking at covering in today's workshop. We have a series of learning objectives from learning 1, 2, 3, and 4, 5, 6. So what we're going to essentially be looking at is the scope of accounting information. We're going to be looking at some of the key financial statements, or in fact, the key financial statements that you will find in any company's annual report. And we're going to be looking at some of the qualitative characteristics of accounting information that determines the nature of information that you read in these financial statements that we're going to be covering today. So I'm not going to read through all of these individually because they're not going to make a lot of sense to you at this stage, but that's essentially in a nutshell what we're covering. The scope of accounting information, the financial statements, as well as the generally accepted accounting principles that guide the nature of the information that you find in these statements. So let's have a look at learning objective 1, which is the beginning assumptions. So we're going to look at the 4 assumptions made when communicating accounting information. Now, one of the important things to remember is accounting is the language of business, right? It is how we communicate about business. It is a global language. So what you learn in this subject applies anywhere in the world, right? So whether or not you plan to work in Europe, the US, Asia, Australia, the information that we cover in this subject is applicable in all cases. It is a global language. Yes, there are select countries that don't use this information, for example, North Korea, but they are very limited. So wherever you go in your career, you'll use this information or at least interpret this information in some way. Okay, so the 4 accounting assumptions that provide the basis of determining the scope of information we see in financial statements are as follows. The first is the economic entity assumption, right? Which is basically saying that the financial activities of business can be separated from those of the owners. So essentially, when you read the financial statements of a business, they relate to the financial activities of that business only. Nothing else. Doesn't combine owners' personal assets as part of, for example, the assets that are reported. Doesn't include personal expenses and expenditures of owners, employees, etc. The financial statements only relate to the economic entity of the business. So we draw a line around the business, we define the scope of that business, we define what that business does, and we capture the performance and position of that information only. The second assumption that we look at is the time period assumption, right? Now, a question that I often ask students is that if you're renting accommodation, so if you're renting your residence, how much do you pay for that residence every single week? And I get answers like, well, I pay $300, $500, etc. The important question is, for what period does that relate? Because if you pay $500 a month in rent, that's extremely cheap in Sydney. If you pay $500 a week in rent, well, that's more normal, at least for if you pay for the whole thing and you don't share it with anyone. Okay, so the time period really is a very important concept and assumption that allows us to meaningfully communicate accounting information, right? We need to know what time period it relates to. And so generally you see with accounting reports, they relate to a financial year. So 1 year activity from the start of the financial year to the end of the financial year. And so that allows us to compare the performance of different entities based on a fixed interval of time. The monetary unit assumption essentially relates to the fact that we communicate accounting information in monetary terms, right? So dollars in Australia, US dollars in the US, euros in Germany, France, Italy, pounds in the UK. And that is the standard. That is how we capture information from the perspective of performance as well as the financial position of an organization. We also have the going concern assumption, which assumes that the company will continue to operate in the foreseeable future. And this affects the nature of information you see in financial reports. Because if you believe a company is not going to continue into the foreseeable future, which unfortunately is the reality for a number of organizations that have been severely affected by the COVID-19 pandemic, then the assets that business holds may not be worth as much if they are divested and liquidated as they would be for that business. And so we need to reevaluate the nature of the information that's in the financial statements if we believe an organization is not a going concern. Okay, so first question I have for you is, estimated revenues for 2021 are recorded in this year's financial reports. Which assumption is violated? So which of the assumptions that we went through before in the previous slide is violated by estimated revenues for 2021 are recorded in this year's, so the 2020 financial reports? Which one? Okay, so now you've answered that question, let's think about it. It's not the economic entity because that relates to separating the business from the affairs of owners, employees, and other parties. It's not the monetary unit concept because that simply relates to the fact we communicate information in financial reports in monetary terms. And it's not going concern because it doesn't have anything to do with the stability of the business and whether or not it will operate into the foreseeable future. What it does relate to is a time period concept. We capture 2020 financial information in the 2020 financial statements only. We don't include estimates of revenue for later years in this year's financial reports. Even if we expect to sell something or deliver a project in 2021, we don't include it in this year's financial reports. That's a very serious violation of accounting standards and something that can get you in a lot of hot water. In fact, when I was at the University of Southern California, we had a visitor series, and one of the visitors was someone who had done time in a federal prison in the United States for forward recognition of revenue to boost the financial performance of that organization. That person had done a number of years in jail as a result of financial fraud, essentially. Okay, second question, which assumption is violated? Business owner's holiday house recorded as a business asset. Does this violate economic entity, time period, monetary unit, or going concern? Okay, so the one it violates is obviously the economic entity assumption because the business owner's holiday house is separate from the business, all right? So we don't include the owner's personal assets that are not part of the business entity in the financial records, right? They are separate. Now, I know some of you are going to say, well, yes, but, we learned previously, if say in business studies, that sole traders, if the business goes bankrupt, then the owners can be are liable in order to service the debt obligations. Yes, that is true from a legal perspective. However, in accounting information, we include only the business assets as part of the financial records. The owner's holiday house does not help the business earn income. It is not related to any of the business's activities and how those activities occur. So it is not included in the financial statements of the business.